Today, damp squib of a rate cut has markets on watch. Hello again, it's Martin North from Digital Finance Analytics, where latest posts covering finance and property news. Well, this is our weekly market update designed to help me digest what's happening, starting in the US, probably the most consequential market in the world. Then we move to Europe, Asia, and Indian Australia, and also cover commodities and crypto along the way. On Friday, shares on Wall Street were mixed in a narrow range as investors continue to assess the outlook for US interest rates. Why 50 basis points, not 25? And was this a minor course correction aimed at bringing a soft economic landing down, or a sign the Fed has left things too long and was trying to head off a lurking recession risk? And was there a hint of political here as well ahead of the US election? Well, it's not really clear. And as for that mythical R star, the level at which rates neither detract from or add to growth remains like the quest for the Holy Grail. One top Federal Reserve policymaker signaled a willingness to cut rates at a fast pace. Federal Reserve Governor Christopher Waller told CBNC that inflation is running softer than I'd thought, and he's now estimating that the Fed's favoured gauge of inflation, that's the Personal Consumption Expenditures Price Index, has risen over the last 3 months at an annualized rate of less than 1.8%, which is below the Fed's target of 2%. But separately, Federal Reserve Governor Michelle Bowman said that she was concerned this week's 50 basis point rate cut was premature, countering expectations of another similar move anytime soon. I believe that moving at a measured pace toward a more neutral policy stance will ensure further progress in bringing inflation down to our 2% target. Bowman dissented, by the way, at this week's meeting, the sole policymaker to do so, voting for a quarter of a percentage point reduction instead. Now we know that the Fed will continue to be data dependent, and next week's US data highlight will arrive on Friday with the August PCE report. Now, if Federal Chair Jerome Powell is right, and the 0.5 of percentage point cut is insurance against any downturn, then the bull market, which has been underway since October 2022, might have further to run. But if Powell is wrong, and the soft landing that investors seem to have locked in turns into something more nasty, or even in the unlikely event that rate cuts set a fire under the resilient US economy, reheats inflation and forces the Fed to tighten monetary policy again, then the pain that long-suffering bears have predicted may not be too far away. The stakes and the uncertainty, which are always high at moments like this when the cycle turns, is extreme. And what could make the fallout from this rate cut particularly dramatic is the starting point, the continuous run-up in equity markets, with the S&P 500 touching record levels after the Fed's big cut, underscores investor belief that economies around the world can pull off the fabled soft landing. But valuations are historically stretched, with investors crowding into winners, tech giants in the US, for example, in a way that have left markets unusually concentrated. Morgan Stanley's US equity guru Mike Wilson provides an important reminder of just how much optimism is built into the outlook for the S&P 500. That's the global proxy for risk, I guess. The index trades at 21 times next year's profit, which assumes earnings will grow 10% in 2024 and then 15% next year. Not only would that 2025 growth rate be about twice the long-term average, but it would also be a remarkable outcome given the most optimistic projections have GDP growing at just 4%. Ardini Research lifted the probability of a stock market melt up after the Fed rate cut, with a caveat. The question is whether exuberance is quickly turning from the rational variety to the 1990s irrational version. S&P 500 foreign earnings per share should continue to rise to new record highs, especially if the Fed's aggressive easing heats up the economy, which has been growing at a steady and moderate pace in the face of Fed tightening, they said. But more wary is Barry Bannister from Stifel Nicholas & Co., who expects the S&P 500 to plunge to the very low 5,000s by the fourth quarter. He sees a multitude of risks, he said. While a 3-year generation high on the price-to-earnings ratio of the S&P 500 and the outperformance of growth versus value stocks may look rosy, peaks in these trends have always preceded bear markets for the past 90 years. Waning labour demand that is symbolic of a recession risk is also a headwind, among other considerations. It takes one generation to forget the dangers of a bubble, and it is Groundhog Day versus the 1990s tech bubble, Bannister wrote to clients in a September 19th note. Just as countries that go rogue become almost uninvestable, investors caught in the grip of a speculative fever become almost unanalyzable. On Friday, the MSCI index of world stocks drooped slightly after jumping on Thursday to a record high, and the S&P 500 closed at its 39th record high of 2024 on Thursday, but it stalled then on Friday, down 0.9% to 5,702. It ended the week modestly higher and held its year-to-date 20% advance, though. The index is up 0.8% so far in September, historically the weakest month for stocks. The Dow Jones Industrial Average closed up 0.09% to 42,063 to hit a new all-time high, and the Nasdaq Composite rounded off the week 0.36% lower to 17,951. And by the way, the small caps were also stronger, while Nvidia waned. Looking at individual names, FedEx tumbled 15% after forecasting it faced a tough year. Nike rose 6.9% after naming a new chief executive officer. Constellation Energy, the biggest US operator of nuclear reactors, surged 22% on plans to put 3 Mile Island back into service, but Trump Media fell 7.8% to a record low. Qualcomm made a takeover approach to Intel in recent days, according to a story published by the Wall Street Journal. Intel has a market cap of $93 billion. Qualcomm is at $188 billion. Intel Corporation added 3.44% to end at $21.87. And by the way, IBM added 1.78% to $217.70. So away from AI, big tech is still doing well. Caterpillar declined 1.2% to end at 368.82, and Goldman Sachs was down 1.07% to 498.43. The volatility index, which measures the implied volatility of the S&P 500 options, was down 1.1% to 1615. Volatility also tends to pick up in October in election years, with the volatility index rising to an average of 25 at the start of the month, as opposed to its long-term average of 19.2. That's according to Edward Jones' analysis of the past 8 presidential election years. In bonds, while the 2-year was up 0.65% to 3.597 and up 0.29% over the week, the 10-year was last at 3.741 and up 2.3% across the week. This pivot to higher rates for longer duration is a significant shift and suggests bond traders are expecting higher rates than previously anticipated. The old adage, though, that when bonds correct after inversion, that's a signal of trouble ahead, should be borne in mind. The US dollar index futures was up 0.19% at 100.74, and the euro US dollar was unchanged at 1.1164. Canada's main stock index on Friday inched past the record high that it hit a day earlier, helped by gains for the shares of gold miners and uranium producers, but the move was limited as investors took stock of recent advances for the market. The Toronto Stock Exchange S&P TSX Composite Index ended up at 23,867.55, moving past the record closing high that it posted the previous day. For the week, the index was up 1.3%, its 6th weekly gain in the last 7 weeks, after the Federal Reserve cut interest rates for the first time in 4 years, boosting investment sentiment globally. Crude prices slipped, though, on Friday, but were still higher for the second consecutive week after the large cut in US interest rates helped quell some fears for slowing demand. The Brent contract dropped 0.21% to $74.73, while US crude futures traded 0.1% higher at $71.25 a barrel. The benchmarks have been recovering from where they fell to near 3-year lows on September the 10th, and have registered gains in 5 of the 7 sessions since then, including gains of over 4% this week. Crude inventories in the US, the world's top producer, fell to a 1-year low last week, according to official government data earlier in the week, but bigger gains were held back by persistent concerns over slowing demand, especially in top importer China. Gold's reaction to the most dovish Fed decision in years proved lackluster. Futures were last at 2,647.20. That's up 1.39% across the week. Plenty of traders thought gold would surge after an outsized rate cut, birthing a new cutting cycle. And with top Fed officials projecting many more cuts, it was going to be big. Gold did rally initially on that revelation, but quickly reversed into a larger intraday loss. Fed rate cuts are bullish for gold generally, but speculators' gold futures positioning is overextended. And that surprise emergency grade 50 basis point cut wasn't even the most dovish thing that the FOMC did this week, with every other meeting top Fed official projections for the federal funds rate trajectory are published. The previous dot plot from mid-June had forecast 125 basis point rate cut in 2024, followed by another 4 next year. That's 125 basis points total by the end of 2025. Not much has changed in the economy in the past few months since then, with traders looking for 9+ cuts. What if those top Fed officials had only forecast 6 or 7? Including this week's, they actually predicted the equivalent of 8 25 basis point cuts. The latest dot plot comes in a bit less dovish than traders had hoped, which contributed to gold's sell-off. The Fed chair's post-meeting press conference played a bigger role in reversing gold and the US dollar, which gold futures speculators look to for their primary trading cues. Jerome Powell warned that no one should look at the 50 basis point cut and say, this is a new pace. The committee is not in a rush. We will move as fast or as slow as we think is appropriate. The US dollar index surged sharply on that, pounding gold even lower. European shares slipped on Friday after a rally in the previous session, spurred by that US Federal Reserve outsized interest rate cut. The pan-European stock 600 index closed 1.4% lower, though it recorded a second straight week of gains. All major European stock markets had steep losses except Spain, which scraped in at 0.2% lower. The DAX index in Germany traded 1.49% down. The CAC 40 in France fell 1.51%, and the FTSE 100 in the UK dropped 1.19%. Novo Nordisk shed 5.4% after results from a phase 2A trial of the Danish drug maker's experimental obesity pill came in below market expectations. The broader healthcare subsector eased 1.9%. Autos led declines, though, among the major stocks sectors, down 3.6%, hurt by a 6.8% slide in Mercedes-Benz, which cut its full-year profit margin target for the second time in less than 2 months. Other industry rivals such as Volkswagen and France's Forvia dropped 3.4% and 8% respectively. The Stock 600 Autos and Parts Index is among this year's worst performers. Analysts predict a 13.6% earnings drop in 2024, a reversal from the years immediately after the pandemic, when supply chain snags handed car makers license to raise prices. Investors believe large cost cuts are becoming unavoidable in a downturn driven by a complex technological shift, fierce competition from Chinese newcomers, and increasingly price-conscious consumers. The sector is caught in the crosshairs of a trade dispute between the EU and China, with the former imposing tariffs on imported Chinese-made EVs on the basis of excessive and unfair subsidies to Chinese manufacturers. A potential return of former US President Donald Trump to the White House could also reignite a trade war with China that would have ramifications for Europe's car makers. Tech eased 2.7% as shares of Dutch computer chip equipment maker ASML lost 4.2% after Morgan Stanley downgraded its rating on the stock to equal weight. On the data front, British retail sales rose by a stronger than expected 1% in August, and growth in July was revised up despite being flat, while consumer confidence has fallen post the election in reaction to the Dow message about tough times ahead from the new government, which is also in a pickle over the PM and others having clothing paid for by rich donors. Eurozone consumer confidence rose by 0.5 points, though, in September from the August number. German producer prices fell less than expected in August, decreasing by 0.8% on the year versus expectations of a 1% decline. Among other headline stocks, Germany's DHL dipped 4.4% following the US rival FedEx dismal first quarter results. Burberry fell 3.5% as Jefferies cut its rating on the British fashion company to underperform from hold and lowered the target price to 490 pence from 800 pence. The Bank of England and Norway's Norges banks both held rates steady on Thursday, although the European Central Bank had cut its key interest rate by 25 basis points after a similar move in June, and could accelerate those cuts over coming months, Governing Council member Fabio Panetta said on Thursday, following the hefty Fed cut and a sluggish Eurozone economy. Most Asian stocks rose on Friday, tracking overnight gains on Wall Street as investors cheered a bumper interest rate cut from the Federal Reserve. Japanese stocks outpaced their regional peers, but trimmed early gains after the Bank of Japan held its interest rate steady, but said it expected inflation to keep increasing. In fact, data released earlier on Friday showed CPI inflation rose to a 10-month high in August, furthering the Bank of Japan's stance. But the inflation reading also signaled steady improvement in the Japanese economy, especially as private consumption benefited from bumper wage hikes enacted earlier in the year. The US economic outlook also rippled into the Bank of Japan's meeting. Ueda said uncertainty around the world's largest economy and market volatility could impact its policy moves. The yen eased after the meeting and was last seen 0.94% weaker against the greenback at 143.92 per dollar. The dollar climbed to a 2-week high against the yen after Ueda's remarks. Japan's Nikkei 225 was the best performer in Asia for a second straight session, rallying 1.8%, while the broader Topix added 1.5%. Both indices trimmed some early gains after the BOJ decision. Chinese stocks lagged as the People's Bank of China kept its benchmark lending rate unchanged despite increasing calls for more stimulus. China's Shanghai Shenzhen CSI 300 and Shanghai Composite indices fell slightly on Friday, lagging their regional peers as a rebound from 7-month lows petered out. The Chinese yuan firmed on Friday, with the US dollar yuan pair falling 0.3% to its lowest level since May 2023. The PBOC had unexpectedly cut the LPR in July, moving it further into record low territory to loosen local monetary conditions. But a raft of recent economic readings showed little improvement in China as weak consumer spending and rampant deflation remains in play. Hong Kong's Hang Seng Index, however, outperformed on gains in technology stocks, rising 1.3%. Broader Asian markets cheered the lowering in US interest rates, given that looser monetary conditions free up more liquidity for investing in risk-driven markets. In fact, India's Nifty 50 and the S&P BSE Senex are trailing only Wall Street's Nasdaq and the S&P 500 as top-performing indices this year, with the analysts expecting the rally to extend into 2025. The Nifty and Senex have gained 18.7% and 17% respectively in 2024, securing the third and fourth spots among major global exchanges. The Nifty was up 1.48% to 25,795. The Nasdaq and S&P have added approximately 22% and 20.5%, slightly ahead of the Indian benchmarks. Japan's Nikkei 225 and Germany's DAX follow India, rising 13 and 12% respectively. Earlier this week, India's weightage in a key MSCI index topped China for the first time as well. India's stock market rally, driven by expectations of policy continuity following national elections in June and a robust growth outlook, gained further momentum after the US Federal Reserve significantly cut rates on September the 18th. Foreign portfolio inflows, which had moderated in August, are on course to hit a 6-month high in September. Australian shares scaled another record high too on Friday, tracking a global wave of optimism that the US Federal Reserve will deliver a much-hoped-for soft landing for the world's largest economy. The ASX 200 added 0.2% to 8,209.5, the highest closing level in its history, and it climbed to an intraday peak of 8,246.2, setting a record for the 6th straight session. On the week, it gained 1.3%. The market is about 12% expensive. On the scale of 1 to 10, I would say the overvaluation is between 7 and 8, said Tim Hex, head of government bond strategies at Pendle. It will be a 10 like it was in 2007 when the overvaluation climbs to 25% or past 9,000 points, he said. That's when you start to hear ringing bells. 8 of the 11 ASX 11 sectors ended in the green, led by consumer discretionary and tech. Family app Life 360 punched 3.2% higher to $18.09, and payment outlet Zip powered up 2.7% to $2.67. The big banks rose. National Australia Bank romped to a 17-year peak and finished 0.4% up at $39.67. Westpac rallied 0.6% to $33.57, having climbed a 7-year top intraday. Macquarie Group ended 0.2% lower, though, at $231.17, despite scaling an all-time high of $233.91 earlier in the session. Miners had a choppy session, with index giant BHP up 0.4% to $40.34, but Rio Tinto shed 0.5% to $113.02, and Fortescue nudged 0.1% lower at $70.63 on still very weak iron ore prices. Department store Myer Holdings fell 0.6% to 87 cents. It dived more than 10% shortly after announcing a dividend cut and a profit slump in the 2024 financial year. Fellow retailer Harvey Norman rallied 1.6% though to $4.96 as investors shrugged off a second class action alleging misleading and deceptive conduct over extended warranty sales. Car equipment maker Bapcor notched a 2.2% gain to $5.13 on news that it was selling its diesel fuel injection business, MTQ Engine Systems, and Regis Healthcare climbed to an intraday of $6.12, the highest since 2015 on plans to buy 2 aged care homes for $35.5 million. It closed at 1.7% to $5.93. Naomi Cotton lifted 2.1% to 73 cents after the board unanimously recommended shareholders approve Olam Agri's fair and reasonable takeover bid at 75 cents a share. For local investors, the focus is on Tuesday's Reserve Bank policy meeting and Wednesday's August CPI report. NAB said that the RBA meeting is likely to come and go with little shift in messaging. No rate changes expected. As for the price data, NAB is forecasting the headline August CPI indicator will be up 2.7% year over year. That's down from 3.5%. Electricity subsidies and fuel base effects drive the lower print, with gradual but ongoing progress expected across other parts of the basket, including market services. Year-ending measures are likely to overstate the sequential progress. We expect the detail to be consistent with our Q3 trimmed mean expectation of 0.8% quarter over quarter, which would see the year-end rate fall to 3.5% from 3.9% in the second quarter, in line with the RBA's forecast. Macquarie's analysis of the last 7 cutting cycles show that domestic equities have a decidedly mixed performance after the RBA cuts, with stocks falling in the first year after the cuts on 4 occasions. Large caps beat small caps, although it should be noted large caps are now already very expensive thanks to the banks, and defensives beat cyclicals. But there is little catch in all of this. If the Fed is cutting rates at a faster pace than the Reserve Bank, which appears to be the case for now, then we can expect the Australian dollar to strengthen against the US dollar. So investors in American assets might find a good chunk of their gains are eaten away by a declining greenback. A rate cut, of course, is unambiguously bad for savers. While bond markets move ahead of central bank moves, short-term money markets adjust immediately, and the Fed's jumbo move will slash 50 basis points off savers' incomes. The rate reductions therefore introduce reinvestment risk for investors. As John Lovetto and Charles Tan of American Century Investments explain, this is the possibility that investors may be unable to reinvest cash flows at the same yield they're currently earning. While the RBA has yet to cut rates, Australian investors are already experiencing this to some extent. The big banks are cutting term deposit rates, reflecting the expectation that the Reserve Bank will follow the Fed. If Australia does join the easing cycle, investors that have enjoyed the benefits of higher interest rates will have to accept lower yields on their assets. The only thing that is guaranteed right now is that investors face a very tricky 6 months as they try to work out whether this is the next leg up for risk investments or the start of a hard landing and the missed opportunity to prepare for tough times. The Aussie was last at 68.06 US cents against the dollar and 51.09 against the UK pound. Finally, in crypto, market analyst Will Clemente reported that there has been a notable increase in the trading activity for Bitcoin, with over $1 billion in contracts opened on BTC perpetual futures in the last day alone. The market is clearly showing more interest in positions, but there is growing conjecture that a quick flush and run on the market might be imminent, which could signal short-term volatility for any gains. According to their analysis, there might be a significant pullback because large contract positions frequently result in liquidation spikes in the event that the market reverses. Traders ought to exercise caution, therefore, particularly in the light of the rising open interest. This kind of market structure usually comes before significant moves, which can be downward if significant liquidations take place, or upward if the momentum keeps going. Important prices to keep an eye on is the 64,000 resistance level. This pivotal point is currently reachable and may indicate whether or not Bitcoin will continue its current upward trajectory. Bearish predictions for the very near future could be nullified if the asset breaks above that level. Though there has been a recent rally, the trend is still exhibiting signs of weakness, though. Bitcoin is encountering multiple technical obstacles, with the 64,000 US serving as a crucial boundary. Readings on the relative strength index points to the asset possibly approaching overbought territory, raising the possibility of a pullback should buyers be unable to hold onto the asset. A MicroStrategy founder and chairman, Michael Saylor, finally commented on a recent published Bitcoin white paper from BlackRock titled, "For investors, Bitcoin is a unique diversifier." Saylor describes the Bitcoin white paper as an excellent research piece articulating Bitcoin's value and dispelling popular misconceptions. BlackRock's Bitcoin white paper provides an in-depth analysis of Bitcoin's journey to the $1 trillion market capitalization. The 9-page document notes that investors' appeal for Bitcoin lies in its detachment from traditional risk and return drivers. Additionally, it shows that Bitcoin surpassed all major asset classes in 7 of the last 10 years, generating an annualized return of almost 100%. According to BlackRock, this performance was achieved despite Bitcoin being the worst performer in 3 of those years. Notably, Bitcoin experienced 4 drawdowns exceeding 50%. The white paper further highlights that geopolitical, fiscal, and monetary stability concerns will likely influence Bitcoin's adoption trajectory. Still, the white paper concluded that Bitcoin remains a high-risk asset, subject to volatility and regulatory challenges, which just about sums it up. And more broadly, I think we can say that markets are unclear about where to head next. There are so many uncertainties, and of course, volatility will be significant in the weeks ahead. I guess the next big story now will be the US election and also what the Reserve Bank here in Australia will do, which is absolutely nothing. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.